Part 2 of my presentation on partnerships. Now, what happens once a partnership is formed and you have to allocate the income as well as account for any draws or capital contributions? Now, partnership revenue and expenses must be closed out at the end of each fiscal year and the net income allocated to each partner's capital account. A method must be devised for assignment of income. Articles of partnership should stipulate an established procedure, and if no arrangement is specified, state partnership law dictates that all partners receive an equal allocation of income or loss. This section answers this question, because I broke this down further, and this is, how do you distribute the income in a partnership? So let's take a look at allocating income to partners when interest and our salary factors are included. So the first thing you always do is you take the net income less interest on the beginning balances, if that's included as part of their compensation, any salary they're paid, or any bonuses, and then you are going to subtract all of this from net income, and the remaining amount is then going to be allocated based on the profit sharing percentages. After you've done this, you're going to take that away from the capital accounts or add it back in, depending on what you end up with, and then you subtract draw last. So the allocation of income is not necessarily based on the relative capital balances. It is a separately negotiated item. Net income is adjusted for any of these allocations, and then the remaining income is distributed based on profit sharing. All right, so now let's take a look at an example. We have a partnership, and it's formed for Pam, Mike, and Dan, and they have the following capital balances at the beginning of 2016. Pam has a balance of $110,000, and her profit sharing, she gets 50%. Mike has $80,000, he gets 20%, and Dan has $110,000, he gets 30%. They have also agreed to pay Pam $20,000 and Dan $10,000 in annual salary. All partners will be given 10% of their beginning capital balances, and they are each allowed to take a draw of $10,000 each year. For 2016, they had a net loss of $20,000, and in 2017, they had a net income of $40,000. So now let's take a look at how does this affect their capital balances at the end of the year. So we start with their balances, beginning balances, and this is how I like to lay it out, because I think it really helps when you're going through the calculation, no matter what kind of problem you're working on when it comes to partnerships. I always like to put the percentages across the top and the balances across the top, and then the names, and then a total. And also try to do this in an Excel spreadsheet because it's so easy to make mistakes. All right, the next thing I'm going to do is I'm going to add in the salary as part of their compensation. I'm then going to take 10% of each of the beginning balances. Now, the reason that this usually is done as part of a partnership is because you're trying to encourage the partners not to take cash out of the business. Okay, so again, you're going to take their balance and you're going to take it times the percentage, and that's how you get the amount allocated. Now what we're going to do is take the salary and the interest and subtract it from, in this case, the first year, a net loss of $20,000. When you do that, you have now a net loss of $80,000. And then you're going to allocate this based on profit sharing. And that's what we've done. We've taken 50% times the 80, which means Pam would get $40,000 of that amount. The last thing we're going to do is we're going to allocate the draw. And then that gives us our ending balances. Now, what we're going to do for the next year is we're going to begin with those balances. We're going to adjust for the salary And again, we're going to take 10% of the beginning balance. If you notice, this changes every year because, let's face it, their balances change. So we took 10%. Now we're going to take our profit less the salary and the interest, and the net result of that is we have a loss to allocate. We're going to allocate based on profit sharing. And now we have, and the last thing we're going to do is we're going to do the draw. So that is a problem a lot of times students have when they're doing the homework. They forget that the draw is not an adjustment to what we consider net income. It comes after that. So now we have our new balances at year end. Now let's take a look at one more. And in this case, we work through another problem. We have Pam, Bill, and Mike. Here's their capital balances, but what makes this one different is that they have profit sharing for if there is a profit, and they have a different percentage if there is a loss. So, in addition, each partner is entitled to 12% of the beginning capital balance, and Pam receives $12,000 and Mike $8,000 in annual salaries, and Mike invested an additional $12,000 in 2017. The net income for the 3 years was a loss of $30,000, then a profit of $20,000, and a profit of $40,000. So what are the capital balances at the end of 2018? All right, here's what we're going to do. We're going to first start with our balances. At the beginning of the year, we're going to adjust for the salary and the interest on the beginning balance of 12%. And then what we're going to do is take the loss minus the salary and the interest. And we have to use the 30, 50, 20 because we have to use the loss percentages, because the net loss after the adjustments is what we're going to use as a basis to determine what percentage we use. Less the draw, and now we get a new balance at the end of December 2016. All right, now we're starting off in 2017. Again, we're going to adjust for the salary and interest on the beginning balances. We're then going to take, even though we had a net profit after we adjust for the salary and the interest on the balances, we end up with a net loss. We now have to allocate that net loss, and again, we're using the loss percentages. And then we're going to add in after that. Now remember, Mike's contribution is not part of the profit sharing. That's shown separately. And then we subtract the draw. And now we have the new capital balance as of 12/2017, which we'll use at the beginning of 2018. Now, we're going to go through the process again. And this year we have a net profit of $40,000. And we subtract out the salary and the interest. It turns out we end up with a profit. So now we have to use the profit sharing based on showing a profit. And so that changes the percentages across the top to 20, 40, 40. Then we're going to subtract the draw, and now we have the new ending balances. Now, what would this look like as part of the financial statements? So let's take a look at that. All right, here's what it would look like. Again, a partnership does not prepare a statement of retained earnings. Instead, a statement of partners' capital is prepared. Changes made during the year in partners' capital accounts are outlined with totals representing the partnership. So in this case, we had our beginning balances for 2018. We have the allocation of the income, and then we have the draw, and now we have the new ending capital balances. Now, what do the journal entries look like at year end? Well, close out the draw accounts, we would debit the capital accounts because draw reduces the draw accounts, the capital accounts, and credit draw. And we would also close out income summary if that's what they're using. So income summary would be debited by $40,000, and then we would increase Pam, Bill, and Mike's capital accounts by their share of the net income after the adjustment for the salary. And that ends this presentation.